Look at the physical reality of any business. Raw materials, labor, and capital are strictly finite, yet human demand is effectively unlimited. This constraint is scarcity. Because resources inevitably run out, every economic agent is forced to make a trade-off. To survive, an organization has to answer 4 structural questions: what to produce, how to produce it, how much to make, and for whom. Relying on standard accounting intuition to answer those questions often masks critical inefficiencies, leading to failures you won't spot on a standard balance sheet. This is why firms utilize managerial economics. It takes microeconomic theory and analytical tools and applies them directly to corporate decision-making. This discipline replaces guesswork with mathematical frameworks to identify the optimum allocation of scarce resources. To see how this works in practice, we are going to reverse engineer 3 distinct business domains: capital investment, human resources, and pricing strategy. True managerial decision-making requires evaluating not just the explicit financial costs of an action, but the implicit, hidden sacrifices built into every choice. Consider a standard capital expenditure. A firm has 100,000 rupees to allocate and 2 options. They can purchase a printing machine or a photocopier. If the printing machine yields 30,000 rupees a year, the standard accounting approach registers an explicit positive return of 30,000 rupees. But this ledger tells an incomplete story. Applying an economic lens reveals a hidden deduction on the right: opportunity cost. It represents the 20,000 rupees sacrificed by not purchasing the photocopier. Economic profit subtracts this from total revenue, showing a much tighter net gain. This dual ledger logic governs all complex capital allocation and asset replacement decisions. To scale this up, managers mathematically plot the trade-offs between labor and capital to reach a state called producer's equilibrium. This chart maps an iso-cost line against a convex iso-quant curve. Their intersection identifies the exact least cost combination of inputs to hit a target output. A textile manufacturer uses this to decide whether to hire 10 workers or invent an accounting illusion if a more profitable alternative was blindly sacrificed to achieve them. That same rigorous logic applies when we shift from capital investment to human resources and physical capacity limits. Without a mathematical framework, managers often assume more labor equals more output. In reality, overstaffing a fixed workspace quickly leads to chaos. To solve this, firms use a production function, a tool that maps the precise relationship between input resources and the resulting output. This graph illustrates a production function, tracking total output on the y-axis against units of labor on the x-axis. Notice the initial segment rises steeply. Adding early workers yields increasing returns, causing efficiency to spike. But as we continue adding labor, infrastructure is maxed out. The curve flattens and eventually drops. This tipping point is the law of diminishing returns. Operating here means workers physically get in each other's way. The overcrowded plant and cost of new hires erode the profit margin. To prevent hitting that threshold, managers rely on a strict marginal cost-benefit rule. A firm must hire only up to the point where the additional revenue generated from the very last worker exactly covers their individual wage cost. Optimizing human resources isn't just filling empty seats. It requires mathematically locating the absolute peak of the production curve before returns begin to diminish. Once production is optimized internally, the focus shifts outward to consumer behavior and the strategies used to price those goods. This diagram shows how a firm derives its demand curve. By mapping a consumer's linear budget line against a curved indifference curve, we track preferences against income constraints. Adjusting the price shifts this intersection, revealing whether demand is elastic or inelastic. Dominant firms take this elasticity data a step further to calculate internal cross-elasticity across their own product portfolios. By manipulating the relative prices of their own substitute products, a firm can redirect consumer behavior to clear out excess inventory of a slow-moving item. We see these metrics applied constantly in retail, specifically through promotional structures, like bulk discounts or buy one get one free campaigns. These campaigns are governed by the law of diminishing marginal utility. This chart tracks a product's psychological value as a consumer acquires more of it. With each additional unit, marginal utility steadily drops. Bulk pricing targets this downward slope, lowering the per-unit cost to encourage purchases a consumer would otherwise reject. These consumer deals operate as calculated elasticity metrics, deployed to maximize firm revenue from every market segment. Production functions, cost curves, and price elasticities do not operate in a vacuum. They are components of a single objective, locating the exact profit-maximizing output within a complex, shifting market structure. This is the baseline for mapping that structure, a market equilibrium graph where the supply curve and the demand curve intersect. But this intersection point is a continuously moving target. It is constantly disrupted by changing raw material prices, incoming competition, and new regulations. This gives the manager a fundamental directive: constantly adjust price and output to avoid resource wastage or unmet demand. If quantity supplied exceeds demand, the firm holds excess inventory and must reduce price. Conversely, if demand exceeds supply, they must raise price and accelerate production. When these precise, mathematically calculated micro-decisions align perfectly at scale across the entire firm, the result is a beautifully optimized system. Mastering managerial economics moves a manager into the role of an active optimizer, securing maximum net profit for the firm and efficient resource allocation for society at large.